Hey guys, what's going on and welcome back to our channel. Investments can be risky, however, they can also prove to be quite fruitful if things are properly planned. Here are 8 low-risk investments with high returns. Number 8, having a high-yield savings account.
But if you're a saver, you are ecstatic because you're looking at savings account rates that we have not seen in such a long time.
What are we talking? What are the numbers?
2.5%.
Many people might think keeping a high-yield savings account wouldn't give a measurable amount of return. However, calculations show that high-yield savings accounts are actually quite profitable. It's estimated that you can gain up to 1.8% to 2% from high-yield savings account, which might seem low at first, but if you compare it to a nationals account, the amount seems quite significant. High-yield savings accounts, as compared to nationals accounts, actually double the amount of return, and for each earning, you'll receive a reward that you're content with, making low investments turn out to be quite rewarding for the long term. It's always wise not to oversee minor steps as such, as they can help you save up necessary amounts of energy, and you wouldn't have to worry about making any rash decisions. Number 7, short-term bonds.
But also within bonds, because that was the trigger, if you like, what happened.
Short-term bonds are less preferred in the financial world due to the short time span, as well as the danger regarding ascending rate of interest. Moreover, the fact that they can come off to seem quite uncool causes people to overlook the benefits. However, short-term bonds are actually found to be more suitable for those who are looking for high returns with low investments. Short-term bonds promise a secure amount within a short period of time and are a better choice of investment for everyone. There are a number of options that you can choose from, each of which are quite suitable. A few convenient options that you can choose from are iShares Core Short-Term US Bond ETF or ISTB, Vanguard Short-Term Bond ETF, BSV, BIV short-term bonds as such are a smart financial decision. The amount that you receive is certainly quantifiable and the rate of risks are comparatively low. It can be said that working smart doesn't have to mean that you must look cool while doing it. Number 6, invest in companies that give dividends.
We're growth of yield stock people. We want dividend companies raising the dividend over time. And you look at like the events of this morning, Chevron and Exxon.
A smart move to avoid risks in investments is investing in companies that pay dividends. These dividends give a great percentage of return, up to 4 to 12%. Dividends are paid to investors by companies to provide reassurance and gain the investors' loyalty. Although companies refuse to pay dividends due to the recent situation of the world regarding the pandemic, it's however predicted that the trend would soon go up again. There are a number of companies that pay dividends to investors, mainly insurance companies, phone companies, and utilities companies, among others. It's helpful to keep an account of the companies that are most likely to pay dividends. A couple of such companies are M&G, Imperial Brands Group, Everest, Aviva, Legal and General Group, British American Tobacco, and Rio Tinto. Number 5, buy shares of Amazon.
Because when the stock is down 30% in a month, it's not going to feel so good to feel 30% dumber. Never spend any time thinking about the daily stock price. I don't.
Amazon sits on the top of the charts when it comes to making fruitful investments. Considering the recent global condition where everybody was confined to their homes, Amazon served to be the main source of necessities of life. Investing in Amazon is the least risky step towards investments. There are a lot of ways that you can invest in Amazon. The most promising option is purchasing shares of Amazon in fragments. A convenient source is investing through their platforms such as eToro. Number 4, property riots.
Booming real estate prices are convincing more Sydney residents to take advantage of the equity in their homes and sell up for something smaller.
For all the investors that have lost a significant amount of money in dealing in the ownership of physical lands, property rights is a rather convenient option. The word rights is actually the short form of real estate investment trusts. It's a method of purchasing incorporeal lands by purchasing stocks. Hence, it's a way of utilizing shares to own lands without having to keep up with expenses regarding maintenance. Property rights are a total risk-free investment, as it not only saves you time and money, but also helps you earn great amounts of return. Number 3, preferred stocks.
When the stock market gets volatile, investors search for safety, treasuries, municipal bonds, stable assets such as those that pay.
Are issued by companies to raise money and trade under a different symbol than common shares. They've been a favorite vehicle for Warren Buffett, who bought Occidental Petroleum. The biggest ETFs invested in preferred stocks saw their assets under management jump by 27% in the last year. Preferreds.
Buying shares of preferred stocks is a smart way to invest, as it promises the investors a fixed amount without any imperils. It's necessary to understand the difference between shares with dividends and preferred stocks. In common shares, there are voting rights which do not permit you to have full ownership of dividends, whereas in preferred stocks, you're given the full advantage. In other words, the owners of preferred stocks get their payment before common shareholders. There are companies that do not offer dividends like Alcoa, and if a person decides to buy a common stock from that company, they will not get any dividends. They'll receive the dividends in just 5.5%. Moreover, a preferred stock is like an all-in-one option. You get the debt from the company, and you buy the company's stocks as well, only you get paid a much higher amount. So it really is a winning situation and a smart move in investments. Number 2, gold.
If you go back to the time of Christ and you look at how many hours of labor you had to give up in order to buy an ounce of gold, and you take it forward to now, you'll find the compound rate maybe 1/10 or 2/10 of 1%.
Gold is the most common investment, and the reason behind it is that gold never spikes down to zero. When stocks lose their value, the value of gold goes up. However, if you're hesitant to physically purchase gold, there's a source similar to Riot known as an ETF. Number 1, corporate bonds.
I would also suggest that if people are just starting out investing in bonds, that you make a handful of investments and then check up on your investments every month and see how they've done. And what will happen is over time, you'll get an idea in terms of how the market really works.
In a corporate bond, you can expect the return of up to 5% and yearly 0.009%. Although it sounds like a low amount, it's perfect for low-risk takers, as it ensures security and a firm amount. However, when investing in corporate bonds, it should be kept in mind to invest only in corporate organizations that provide grade A or B+ bonds. As it goes, work smarter, not harder. Life is simply too short to take more risks than we can handle. Handling risks is a job not made for everyone. However, there's nothing wrong with playing on the safer side and making smarter decisions, especially when it comes to earning high investments. So do give us your thoughts regarding all of this in the comments down below, and I'll be catching you guys in the next video. Take care now.